And dear traders around the globe, we would like to say welcome here to our real-time daily trading idea webinar. 5 days, 5 traders. We would like to screen the market, show you some interesting trading setups and answering your questions. But first of all, we need to say here our disclaimer. Be aware that Forex and CFDs are leveraged products and can result in losses that exceed your deposit. So there may not be subtitle for everyone, and please be aware that all we're showing and presenting here today is just a personal opinion of our expert traders and not an advice for investing. As I said at the beginning, here you can see some pictures from our traders. Today is Monday, so today is with Jay. Later more about Jay and his trading style. So here a quick overview of some of our offerings. For example, here our DAX 30 with a typical fixed spread of only 0.8 points during the main trading hours. These and other products you can also trade in the mini contract size. So on the right side you see some awards from our customer service. If you have a later additional question, you can contact us here, our telephone number and also our email. You can see here on this slide. You will find it as well on our website. And here additional info for you. These webinars are always recorded. So
Die Stummschaltung ist aufgehoben.
So here's a picture from Jay. So I say good morning to you, Jay. Hope you're doing well. You have the screen and you can start.
Hey, good morning to you. Thank you for the intro and good morning, traders. It's a short-lived week. Let's see if I can share the screen with you. Which screen are you seeing? Give me a sec. You got to see this screen. Let me see if it switches over and then we can get rolling.
Yep, Jay looks fine. We see your picture as well. You can start.
Okay, great. Headlines real quick. We have a sort of risk-on environment, even though some of the recent gains from the overnight headlines are being pared back as we speak. We do have UK and US market holidays today, as well as no expected Tier 1 data. Tier 1 means really important market-moving data. So the two largest liquidity centers are not online today, so nothing really to do for us. Italy. Designated Prime Minister Conte gives up on forming a government. That was the major headline overnight after President Mattarella rejected the Eurosceptic Savona as economic minister. So there's a lot of hatred going on and back and forth right now. There's talk about impeaching the president. Moody's already placed Italy's credit rating on Baa2, on downgrade watch, sorry. And there's a lot of uncertainty in the market. Potentially, there's new fresh Italian elections in September, which currently see the Eurosceptics increasing in popularity. So we need to keep this on the radar. On the other hand, there is a saying political bourses have short legs, meaning anything that's politically driven may not be that sustainable in the market. Spain, we also have a potential no confidence vote initiated by the opposition, the Socialist Party over there versus or against Prime Minister Rajoy. And if that comes to fruition, that would be midweek. So there's a lot of uncertainty politically, but fundamentally the euro is expected to show some currency positive economic data this week. Also, US-North Korea summit may be back on. I have to say, I am at a lack of words when it comes to how this US president is acting. This whole bit about twittering, I'm going, I'm not going, and it's been going on for over a year now, is just, it's unbelievable. There's no trust. This is not the way to conduct business, let alone lead the #1 country in the world. I'm still neutral. I'm not pro, I'm not against. I'm just saying communication is of utmost importance and being transparent and clear and non-threatening and political. And this is not statesmanship-like behavior, and it's troublesome for the markets going forward. Then we have a slide in crude oil. Why? Friday we had Saudi Arabia and Russia news hitting the ticker that they may be raising output to make up for the lost output from Venezuela, for example. And overnight session we had WTI briefly dip below the 66 handle. We then recovered. There were buy limits that absorbed, and we had a break hook and go higher. We also had the US Baker Hughes total rig count increasing again. So the fracking companies are increasing supply, the offshore drillers are increasing supply, and Saudi Arabia and Russia are talking about potentially increasing supply. And the quota fulfillment of OPEC plus, i.e. OPEC and non-OPEC members, for the deal in terms of reducing supply was at over 150%. Fulfillment of the quota. So if new supply is hitting the market now, we can see the according reaction in price. On top of that, we had extreme positioning by producers and swap dealers in the commitment of traders report. So the short in oil was long waited for. UK is reported to be lacking a no-deal Brexit. That means PMA is in the weaker position when it comes to the negotiating table, and that is going to be of interest for the coming week. Currently, UK closed, so nothing to do here. Trade review, our last trade is 2 weeks old. At the time, we were longing Aussie versus yen, and as you can see, we had a winner. So far, hit ratio 71%. That pair even went on to higher highs, 84.50 area, and was rejected then and came back to where we actually went long. Overnight, as you can see, I added this so you can read the indicator a little bit better. Overnight, we had New Zealand dollar strength and Canadian dollar weakness, and then the euro dollar weakness, the euro weakness in the last hour. And I'm looking over, euro weakness continues. Risk events this week, our eye is on, no, that's wrong. No, that's correct. Sorry. RBNZ financial stability report. Then we have German CPI numbers and retail sales as the #1 economy in the EU. That's of interest to us. Then we have this week Italian 10-year bond auction. They have 130 billion euros to refinance left for this week. And if Italy gets downgraded, that's going to have an impact on what the ECB, i.e. Mario Draghi, is allowed to buy and not to buy. So either this purchasing key, that's what it's called, the program in order to buy sovereign debt is going to have to be changed to increase the bucket for worse ratings, or something has to give. So I'm very interested to see how that 10-year auction of Italian sovereign debt is going to perform. My expectation is that they have to pay more than 1.7%. We have ADP, we have current account in Canada, and we have on Wednesday the Bank of Canada rate statement. Expectation of the market currently is for, well, on Friday when we closed, there was a 30% probability that they will hike rates. But now the expectation for the next rate hike is in July, and then one more in the fourth quarter. For Thursday, we have some PMI numbers out of China. Those are the official numbers, and on Friday, the more unofficial numbers. Formerly the HSBC, now it's called Caixin PMIs. We have private capital expenditure out of Australia expected better than last time with 1.1%. We have net lending is of interest to me. I want to take a look at consumer demand for loans in the UK. If the consumer is positive on his or her future employment, then they're happy to go to the bank and get another loan. So loan growth is expected, which is equal to economic growth. That's why I'm keeping an eye on that. Euro, we have CPI and core CPI, and that's expected to be higher than last time. So this is what I'm talking about. So politically, we have a short euro, and fundamentally for this week, we have a long euro. So we'll see which position wins. Canadian dollar, GDP, worse than expected. Here, of course, since it's coming one day after the rate announcement, my expectation is for it to have less of an impact. Then we have core PCE, the Fed's favorite inflation gauge. Here too, expected to come in a little bit weaker, and it's also, for your guide, lagging CPI. I'll allude to that in a second. And then we have unemployment claims coming in line, similar to last time. And then, of course, like I said on Friday, the Caixin PMIs out of China. Recall that Japan, Eurozone, and US, all the PMIs, manufacturing and non-manufacturing, recently came in weaker. So I'm interested to see if the Chinese PMIs are also coming in weaker. And then we have average hourly earnings expected to be coming in a little bit higher than last time. And it's also something that we keep a close eye at. If you may or may not recall, this number jumped unexpectedly high last February, which then actually caused yields to jump, which that actually helped cause the equity sell-off. So all markets are linked. You need to know what to focus on. And for currency trading, it's important to know what the individual central bank is focusing on. Here's that number. I dug it out for us. Core PCE in March was 1.8% year on year, and core CPI in April was 2.1 year on year. So the Fed already communicated that they're a little bit more cautious when it comes to the pace of their hikes and the absolute number of hikes. On the other hand, they said they're completely fine with overshooting their 2% inflation target for a bit. Non-farm 190 versus 164, unemployment rate expected at 3.9, and average hourly earnings year on year expected to rise to 2.7 from 2.6. So this is one of these indicators where they're happy to have it overshoot for a little bit of time. In order to combat expected inflation, central banks raise rates, and that is the name of the game, because the currency eventually then follows the rates. Continued tightening in the labor market. Most of the market participants expect that wage growth will pick up throughout this year, and hence the pace and number of rate hikes expected for this year. Canadian dollar, we said it already, third meeting in a row where the rates are expected to be left unchanged. In July, the next 25 basis point rate hike, and then in the fourth quarter, the next one. That's the current expectation. If it comes different than that, here we go, Canadian dollar weakness. This is important for you guys to know. The Bank of Canada is concerned with domestic debt and the housing market, especially given how are these two developing in a higher rate environment. Yeah? If a lot of this domestic debt by Mr. and Mrs. Smith is variable, that means that their expenditures on a monthly basis to service their debt is increasing. And the same goes for the housing market. Depending on how many mortgages are variable rate mortgages, these reset according to an increased short-term interest rate, which the Bank of Canada is responsible for, which they do to prevent an overheating of the economy, means it has an impact on domestic debt and housing market debt. So we need to keep an eye on that, because the BOC is keeping an eye on that. And if we see that wages are not growing and the retail, the households are getting squeezed in terms of their disposable income, that means the BOC will step on the brake, and that means then weakness in the Canadian dollar. So this is the type of thinking that the market, the professional players in the market undergo. On top of it, we still have uncertainty when it comes to the North Atlantic Free Trade Agreement, and that is weighing in a negative way on business sentiment and business investments. The GDP growth on Thursday, even though on the month-on-month number is expected to come in lower, you need to be aware that this is a 1.8% year-on-year number, and that's completely in line with the Bank of Canada. So if you're very bearish and you expect the Canadian dollar to sell off on this, this is pretty much baked into the market already. Thursday CPI flash estimate, I said this already earlier. The year-on-year is 1% versus last time 0.7, and the 0.7 was a 13-month low. So we do see a little bit of a pickup in inflation in Eurozone. Of course, the higher fuel prices helped, and of course, fuel is coming off as we speak. So we need to see that development going forward. I mean, keep an eye on it. And then recent commentary by ECB officials already said, hey, just like the Fed, we are okay with an inflation overshoot for a bit. ECB pretty much always follows, not always, but pretty much tends to follow the playbook that the Fed has already implemented. We're just a little bit behind the curve. So the Fed is in a hiking cycle, and the ECB is basically still in an expansionary cycle when it comes to monetary policy. And then Thursday, PMIs out of China expected to be unchanged officially and unofficially. I saw a number earlier from Reuters that actually says 51.0. So we'll just keep this on the radar in terms of having an impact potentially on global growth and demand and on the Aussie dollar specifically for us as currency traders. And then, as said this again, recent PMIs out of US, Eurozone, Japan all came in a little bit weaker. So I'm not that surprised if the PMIs are coming out a little bit weaker out of China as well. Positioning. We have a long in Aussie. Once I'm out of this meeting, I'm going to see what positions I can put on in terms of longing the Aussie. And we have a potential long signal in the Swiss franc. Volatility, we can see that the euro increased. Of course, there's political instability at the moment out of the third largest economy. That's the reason. We see that the pound increased a little bit. Yep, we had a little bit of Brexit headlines coming back into the market. We have yen volatility increasing. That's due to risk off last week. The risk off sentiment in the market last week was due to the summit between North Korean leader Kim and President Trump being canceled by Trump. And then he once again made a 180 on this issue, and now the summit seems to be back on. Unbelievable. And the VIX sort of in line, slightly higher than last time we spoke a couple of weeks ago. Option pricing, not that useful because it's a long holiday weekend. UK and US are off, so I'm not giving that much attention to it for the London session today because there really is no London session. So these are just to go through the motions because we always put in the same process every single day. And every single day, before the market opens, we know what we want to be long and what we want to be short. But as I said, due to the holidays, long holidays in the US and the UK, these are pretty much not that much value to us at the moment. So I'm not even going to go through them. Here too, the large spec positioning out of Chicago. These are the very large speculators. They're coming off their US dollar short a little bit. They got squeezed out of their short positions. But we have two opposing forces. On the one hand, we have the so-called twin deficits in the US, which structurally mean medium to longer term a weak US dollar versus the short squeeze at the moment and the tax deal implemented by the Trump administration, which basically can cause $2 trillion US dollars to be repatriated outside of the US onshore. If that happens, and it's still happening, you will see short-term rates increasing, the cost of dollar funding outside of the US continuing to increase, and that obviously puts pressure on anyone who has debt in US dollar because debt servicing got more expensive that way. Potential trade of this week, super, super, super aggressive. Okay, I could be wrong on this because I did not see a reaccumulation yet, but I'm looking to long euro versus Canadian dollar. This morning we did see a brief relief rally. It pretty much really went overnight, not so much this morning after the Italian anti-EU government was averted for now. And we are expecting stronger inflation numbers for this week in the euro. So I'm looking for big boy accumulation. And once I see it confirmed, I would like to long the euro, crazy as it is, right? But there you can see I'm coming from the institutional side. I used to be a market maker. That means I'm always on the opposing side of you, always. I'm never trend following. I'm always the guy on the other side. And that training over 20 years is deeply ingrained. So apologize if this makes you feel uncomfortable, but this is the trade that I'm looking to do versus Canadian dollar because there's a gigantic repositioning in the market happening. The buy side is too long oil right now. So I'm expecting repositioning to carry on, even though I did see a very good long signal at 4 o'clock this morning in the oil market. So we'll have to see how far that runs. So we have weakening oil and a probability of a rate hike getting priced out of the market for the Canadian dollar because oil is coming off. I hope that makes sense a little bit. So the trade structure is 2 limit buy orders as always, and the risk for my trade is multiple risks. So we have Spain and Italy in terms of headline risk political wise. We have the potential for euro inflation numbers to disappoint if they come lower than expected. We could have a more hawkish Bank of Canada in their statement, and or we could have a recovery in the oil price if it dropped too far too fast. So do not, under any circumstances, join me on this trade if you don't know what you're doing or if you don't feel comfortable. This is not the highest conviction trade at the moment. And anyways, I'm looking to long around the role reversal here. And I'm looking to long where I'm assuming liquidity below the last swings, and I have confluence of various technical indicators right there. Hang on a sec, VT, you're saying what about New Zealand Canadian dollars? Thanks for the insight. Let's have a look. I'm not seeing anything in terms of New Zealand dollar except for this week on the docket. I mean, let's see what's on the docket. None. And thanks for the question, by the way, mate. All, apply, filter, go. Okay, so this week, this Forex factory calendar is nuts. Okay, so let's take this off, and then I can show it hopefully without the guys from Medrow getting upset. Well, there's one competitor advertisement, so I'm trying to show it this way. Okay, cool. No advertisement. I'm gonna hold it like this. No, you can't see it. All right, screw it. Anyways, New Zealand, financial stability. Then we have building consent. We have or speaking. You always need to double check where is the guy speaking to testify about financial stability before the parliament. Okay, that's good. That's Q&A. So there's some volatility expected here. Business confidence. How was the recent development in terms of business confidence? Shitty. Oh, sorry for my French. Negative. And we have overseas trade index expected to come in worse. Q&Q, change in price of internationally traded goods, actually greater than forecast is good. So, not really seeing that much fundamental arguments to long the New Zealand dollar at all. Canadian dollar, are you saying long or short, VT, in terms of your question? VT, are you still there?
Sorry, Jay?
Oh, okay. He's saying long.
You mean,
Sorry.
You mean of our audience.
I got him.
Sorry.
I got him. VT, if you want, why don't you look at Aussie New Zealand, Aussie Canadian dollar long? That would make more sense in terms of positioning from the big boys. You did. Okay. And how come you came to the conclusion New Zealand dollar? What is the catalyst for the coming week to accelerate and have big boys long the New Zealand dollar? And don't say technical. Nobody in terms of the big boys is looking at technicals. Oversold. Yeah, that's a technical. Are you looking at RSI or MACD or something like that? You got to look at positioning and implied volatilities. That's the type of stuff of technical that big boys are looking at. Not, nope, trust me, nobody at PIMCO is looking, for example, or BlackRock or God knows who is looking at a chart to long New Zealand dollar. Also, how much trade is going on between New Zealand and Canada? Think about that in terms of liquidity and actual trade going on between the two markets. I'm trying to teach you guys how we think on the institutional side, away from looking at a chart. A chart should not, if at all possible, give you a reason for a trade. It can confirm your entry and your exit, but the reasoning always has to come from a fundamental point. Okay? If you follow us for a while, maybe you'll see what I'm trying to say. But I do appreciate your question, and I really enjoy having this conversation with you. I appreciate that. Thank you, VT. Euro Swissy, Renata, Euro Swissy short? Last question. Hi, Jörg. Good to see you. Saw one of my traders in here. Renata, are you still there? Okay. I think, or I'm hoping she means short. Are you saying short Euro Swissy or long? Long. No, I can't short the Swissy. The positioning from the big boys is too extreme. So I think what you might be thinking is relief rally euro, similar to what I'm thinking, and then intervention by the SNB against a Swissy that may get too long. So if that's your thinking, I tend to agree with you, but I don't have anything on the economic docket this week that could push. So what do I mean by that? Let's go back to this slide and then we close the meeting for today. Teach you a little bit. This stupid computer is just too slow. I apologize. Okay, it's not working. Okay, it's too slow. What I'm trying to say with docket is really this. If we look at all the currencies, and if we're here, this is where the big boys are pre-positioning based on. All right. So everyone at a fund, anyone who has anything to do professionally with currencies knows that Friday night the probability of a rate hike was 30%. Everyone knows that last night the oil market sold off, okay, and that there's new supply coming in. We all know that. We know Saudi, Russia, the headlines. We're very familiar with the positioning. The short was coming. It was in the making based on the positioning by the big boys, okay? So there's potential inherent weakness. We know that the Bank of Canada is looking at the housing market and domestic debt. This is what we know. This is what then can trigger a continued sell-off. But as a market maker or as an institutional, I'm moving millions and billions in the market. So I always need volume. I can't just go long or short anywhere in the chart because it will kill my average execution price, okay? So I'm not seeing anything in terms of Swiss on the docket that could help for this week. So go back to this, try to find a reason why a currency may move and then execute on that. And like I said, my euro Canadian dollar is pretty much based on relief rally and the Canadian dollar weakness in oil if it continues. And I'm not seeing accumulation by the big boys yet or stopping the down move. So I first need to see confirmation in that. It's very difficult for me to give you guys a trade, and I'm only doing this because I'm pretty much forced into showing you a picture. So me personally, if I sit in front of the market, this thing is not working, I'm waiting to see confirmation in the chart. So that, for example, VT is what I'm looking at, confirmation in the chart, but not the chart being a reason for me to go long or short in any given pair. And I apologize that this computer is so super slow. I just wanted to go into this chart real quick, right? So we need to see stop runs, for example. Stop runs are a very good and positive indication that we're heading in the direction that fundamentally or sentiment-wise is given by the market. I hope that makes a little bit of sense. One of my traders says he's going to give me for my birthday new computer, August 18th, like Napoleon. Guys, let's call it a day. It's already 30 minutes. I don't think I'm allowed to speak that long. Thank you for your cooperation, Renata. Thank you. And VT for your questions. Thanks to my traders for showing up every Monday morning. There's a lot of guys in here. Enjoy the holiday, and tomorrow we can get back busy again with hopefully making some pips. Thank you for your time and your interest. I really appreciate you. And thanks to Admiral Markets. Speak to you guys later. Bye-bye.
Okay, Jay. Yeah, thanks for your showing us here the fundamental data from this week. So yeah, and for showing us here some interesting trading setup for the next days. So yeah, thanks again for your listeners. So tomorrow we are back. We're at the same time. You always feel free to join us here. So have a good day and see you tomorrow. Bye bye.